Joining us now to talk about the week ahead and Fed Chair Powell's speech at Jackson Hole on Friday, Luke Tilley, former officer and economic advisor at the Federal Reserve Bank of Philadelphia and currently chief economist at Wilmington Trust. Luke, good morning.
Thanks for having me.
We were just trying to break down Powell's speech, the message. I guess one of the chief takeaways is tries to preserve flexibility. We're at a point in the cycle where you have to see if what the rate moves already have done might do to the economy. At the same time, you can't take further disinflation for granted. What do you think it means for markets?
Yeah, I think that markets didn't really learn a whole lot from Chair Powell last week at Jackson Hole. He sort of restated the overall case. They've had an economy that is slowing, but I think within that assessment of the economy was sort of his most hawkish statement was talking about consumer spending in the most recent months having been particularly robust. And that sort of sets off some alarm bells that they're really worried that strong spending is going to keep inflation up. But on the other side of it, and he was a little bit balanced here, on the other side, he said that financial conditions have been tightened quite a bit. And then importantly said that most of the estimates that they use, they say that there's still a lot of tightening in the pipeline. So they're still waiting for some of those lagged effects to come through and to have an impact on inflation. And I really think what he set up was to just punt at this next meeting on September 20th and be looking for November 1st because they've got 3 more PCE inflation readings between now and then, Mike.
Right. Yeah. So there is a little bit of kind of breathing room, I guess. The markets can sort out each bit of information that comes through. I guess the emphasis of Powell on PCE inflation in services outside of housing. So he's kind of focused in again on that component of inflation. A lot of folks will say, look, the leading indicators of that measure look like they're going to be pretty friendly for a little while here. Do you think that we can continue to have the so-called immaculate disinflation?
Yeah, I think that the inflation data has been really encouraging. And frankly, the Fed, I think, knows this too, but they can't speak in the same ways about it because they don't want financial conditions to loosen up too quickly. Those service industries outside of housing have really done well with the high costs. Everybody's worried about those average hourly earnings and the high wages, which, of course, is a large part of their cost structure. But even though those wages have stayed high, we've seen in producer prices that basically firms have been able to handle those high wages and bring their selling prices down. And that really bodes well for that services side. So we do expect inflation to keep coming down. But it could be challenged if it does, reverse and go the other direction. And of course, the Fed wants to see several more months of data before they take action on it.
And now, of course, we've seen longer term Treasury yields trend higher. They're kind of hovering just above below 4.25 on the 10-year at the moment. That's not really been because the market expects inflation to pick up again. It's been other components or maybe other drivers of this, whether people think it's Treasury supply or just real rates going up because the economy might be in a better growth phase. What's your read on what's driving it? Is it an opportunity for bond investors? Is it a challenge for risk asset markets?
Yeah, at Wilmington, we really think that it's an opportunity. We actually have an overweight to core fixed income. And we do think that those rates are going to come back down. As you said, it's not really inflation that's been driving them higher. If you look at the 10-year break even, it has come down since its peak late last year. Really, what's been driving it is real yields. And we think it's the really strong economic data. You've got the surprise indices really moving up. You've got the Atlanta Fed's GDP Now tracker tracking at almost 6% growth in the third quarter. And I think that has spooked the markets a lot and really sent those long-term rates higher. But we think we're still looking at a 1% to 2% growth economy. There's just a lot of volatility in that data. And we think that should bring long-term rates down. And that really provides some opportunities on the fixed income side. So we're advising clients to stay overweight to fixed income. And then we also have an overweight to cash. And we're looking for opportunities to deploy that depending on how the data breaks.
Yeah, I guess in that scenario, if in fact we trend back toward a 1 or 2% growth rate, longer-term yields trend lower simply because, as you say, we get through this acceleration phase in the economy. That's not a friendly enough environment for equities to hold up, you don't think?
Well, it could be friendly for equities, but we're also very conscious of the high valuations for large cap, which, of course, have run up so significantly this year. The valuations look better on the small cap side. So we're looking for possible opportunities there. We have had an underweight there for most of this year and looking for that opportunity because there still could be some volatility as the Fed talks hawkish for the next couple of months. So we're looking for those opportunities. It could be good for equities, but with those long-term rates as high as they are, it just looks really attractive. And you have all of that carry. You really don't even need that much spread compression on the fixed income side to beat that 5% cash rate. So that's why we're tilted a little bit more towards fixed income now, even though we're not that negative on the economy, Mike.
Got it. Yeah, the hurdle is higher, I guess, for taking on more risk at this point.